Hi, my name is Michael Corcelli. I'm the founder and chief investment officer of Alexander Alternative Capital in Miami. And today is Non Farm Payrolls. Non Farm Payroll Friday comes out the first Friday of every month, major macroeconomic indicator. We love to follow it because we're nerdy, job report, hedge fund guys. And it's the biggest, most important piece of data that comes out on a monthly basis that businesses basically determine their agenda and how aggressive it's going to be or not going to be off of that data point. And today it comes out at 8:30 in the morning. We're getting started now. We're going to pull it up. We're going to pull it up right now and take a peek at it. The number, according to the survey in Bloomberg, which is a bunch of different economists of banks, is 180,000 jobs. So the economists and the averages call for 180,000 jobs, and what we see today is the number came in at 151,000 jobs. Not as good as expected. However, if you dig a little deeper into the number, into this column over here, you see the prior month. So the July number came in at 255,000 jobs. However, it was revised, and it was revised upward, meaning the economy in July created an additional 20,000 jobs. So if you add that, the survey's pretty close, and things came in pretty much in line with expectations on the headline number. But you got to dig into the number a little bit deeper to really understand where the potential weakness is, and we see it here in private payrolls. Private payrolls came in a little bit weaker than expected, and manufacturing shed about 14,000 jobs in the month of August. The unemployment rate was supposed to go down according to the survey to 4.8%. However, it held steady. And labor force participation rate most likely held steady as well, but we'll get into that in 1 second. Average hourly earnings month over month was supposed to come in at 0.2%, meaning that what people were paid was supposed to grow by 0.2% month over month, and people should have made a little bit more. However, when you look at the actual number, it came in weaker than expected at 0.1%. Now, why is this important? So the reason that this data is important has to do with the fact of inflation, and central bank policy traditionally has been set off of the amount of jobs where we are with unemployment and the wage inflation pressure. So one of the precursors to a Fed rate hike, traditionally speaking, over the last 100 years, has been when wages started to show signs of going up, the Federal Reserve would preemptively raise interest rates to keep that pressure down and allow the economy to continue to expand and create jobs. But since the financial crisis of 2008, there hasn't been much, if any, wage inflation on a yearly basis. So central bankers like Janet Yellen are following this number extremely closely, and this number is not a confidence number today. We would like to see it come in at survey or even a little bit better than it had come in. So anyway, the year-over-year number is just a factor of how that monthly number came in. Average hourly work week came in a little bit less than expected, meaning employers gave employees the opportunity to work less. Not a sign of a super strong economy. So this number today, it's pretty much a a non-factor, and if you see here, the labor force participation rate didn't change. None of this stuff really changed. Everything was pretty much in line with consensus. But let's take a quick look at like markets and how markets are responding to this data, because you don't really care about the data. All you really care about is making money off of the news. And we can see that when the number came out, European equities, the Stoxx 50, it popped. It had a nice little pop here, and that was a sign of bullishness for European stocks, which most likely means that the number was benign enough that's going to give the Federal Reserve a chance to sit on their hands. And when somebody sits on their hands, they don't really do anything. So that's how I personally interpret this data this morning, is it's much ado about nothing, and it doesn't give the Federal Reserve any more or any less incentive to raise interest rates at the September 21st meeting. Let's take a look at some commodities. Let's take a look at bonds. Let's look at how different things performed. You can see on the number here at 8:30, bonds initially went up in value, yields went lower, and then they came crashing down, and they went back up in price. So this is seen as bearish for the 10-year U.S. Treasury, bearish on prices. So the curve is steepening a little bit. It's showing a healthier economy. Let's take a look at some commodity prices and how some commodities actually looked. We're going to take a look at crude oil. So you can see here, crude oil jumped a little bit, but gave back. Natty gas, same story. Gold is doing good today. Look at that. Gold is probably one of the stronger ones. Let's look at Dr. Copper. Here's Dr. Copper, my favorite. It diagnoses, macroeconomic events. And on this news, Dr. Copper fell. So Dr. Copper doesn't believe in this rally here. What else? What else can we take a peek at? Let's take a peek at the dollar. The dollar is an important factor here. We believe that the dollar is going to drive the direction of commodities, and it's going to drive the direction of pretty much all asset classes. And if the dollar starts to gain strength and rally, pretty much all commodities are going to get murdered, and corporate profits are going to get tightened, and there's a chance that there's a correlation event. So if you look at in the past how related these things are, you find very, very high correlations between dollar strength and weakness in other asset classes. So let's zoom in here to that 8:30 and see pre. So here's pre-announcement, and then right here is on the announcement. The dollar started to sell off, got a nice little bid, started to go higher, started to sell off, and now it's heading higher. The dollar is heading higher, it's getting stronger. This is the DXY dollar index. It's versus a basket of currencies. But let's check individual currency performance versus the dollar. Let's take a look at the Japanese yen. And we see very much similar pattern here on that 8:30 announcement. Dollar's gaining ground. Japanese yen is pretty weak. It looks like the euro has got a little bit of strength versus the dollar, though. The euro initially spiked, and then it actually has come in. Today's going to be one of the slowest days of the calendar year, and this number is so benign that it hasn't really caused any increases, and there's nothing significant about it. We're going to do a deeper dive into this number and really look at how we believe the conversation is going to unfold from the perspective of a rate increase, because we believe that's going to drive the dollar. That conversation is going to drive the dollar either stronger, it's going to drive the conversation, to stay the same or weaker. So we'll do a review later on in the day. We'll post it up to the website, send it out to everybody. I want you to take a look at the dollar here on a longer term basis. We're gonna, it's pretty much sideways since a year ago, but you see it keeps coming up against this 200-day moving average from a technical perspective, and then it had a nice bounce off the 50-day moving average, and it looks like it's going to be making a decision on which direction it's going to go in the near term, but it's definitely had resistance on that 200-day moving average, and whether or not it's going to be able to break out, we believe it's going to be determined by a rate hike or not in the short term. And obviously that doesn't hold true on a longer term basis, but on a shorter term basis it definitely holds true. So with that said, we want to invite you to our global macro perspective at the end of this year. We're bringing together the heads of firms, we're bringing together think tank people, we're bringing together the smartest people in macroeconomic research, and to think about geopolitical issues and major macroeconomic trends, and to discuss these issues prior to the new year. So if you haven't been to one of our global macro perspective events, this is the 6th year. It's during the Basel timeframe, and it's an amazing time to be in Miami. Our conversation that we've been creating on a regular basis is very, very timely. It helps you to think through the issues that other professionals, other investors are thinking about heading into the new year, and we want to invite you to attend. We'll be sending out some save the date information. If you're not inside of our database yet, please go to alexanderalternativecapital.com, ask to be added to our mailing list, and we'll make sure that you get an invitation. Don't miss the opportunity to hear from the smartest minds in Macrolandia. Anyway, thank you for coming to our live update. We can't wait to see you next month. Please continue to tune in on a daily basis and also watch our live. Take care.